Hello, ladies and gentlemen. How are you? I hope you are doing well wherever you are. I am the ACCA tutor, Mr. Jerry Mutimukulu. Um, Let me write down my name so that you guys won't mistaken me with somebody else. Okay, I'm Jerry. Um, Mutimukulu. Okay, and I am a fellow of the ACCA. Okay, and registered public accountant, uh, Zimbabwe. All right. Now, you can get in touch with me on this number +263 774 596 368. Okay, the number is also compatible with WhatsApp. Now, in this video, I'm going to delve into inventory control. All right. We will do, venture into those areas where we ask ourselves, why do we need to worry about inventory? Safety, the safety of the inventory, or the control mechanisms in place to ensure that the inventory is in sufficient supply, sufficient quantities, and we are not going to run out of stock should an erratic demand um, occurs. Okay, so we are always going to be safe. Remember, it is from uh, selling the inventory that we achieve our profit maximization, especially wealth maximization agenda to those companies who survive on buying and selling goods. Okay, we are not talking of services. We are only worried about the physical good. All right, we are worried about the physical good. So previously we have been dealing with the inventory valuation. Okay, we had covered a topic on inventory valuation where we identified the FIFO as one of the method of valuing inventory, the LIFO, and the AVCO. Okay, these were the methods which we identified and we discussed about them in the previous videos. All right, and to those who have been studying this module with us, um, they, I mean, they know that we have pre-recorded videos which are explanatory, where we take you step by step explaining these concepts. All right, and after watching the video, you are not going to go anywhere before you complete a week's assignment. The relevant week's assignment. So in particular this week, uh, a lot of students have been finding it challenging to attempt the questions, but that's the reason why you need a tutor by your side, because when you are stuck, you need to be assisted. Otherwise, if you term the ACCA Django alone, you will discover that instead of just finishing this professional course in terms of examination, you need to finish it in 1 to 1.5 years. But most people, because they want to be ninjas, they want to be fighters, superheroes, supermen, they end up spending 8 years without finishing the qualification. So some people, I met a group of people, some abandoned the ACCA qualification and then started to go to the university. They went to the university, they spent 4 years doing a bachelor's. After that, they were then told that you are only going to get 6 exemptions. So they get back to the ACCA qualification again. They started and they find out that, oh, the university staff had some advantage. There were some, these assignments which in some universities they give you almost 40%, and you're only going to just suffer yourself for the 60%. But in the ACCA world, that's something that doesn't exist. You need to get your 50% from sweating. You need to work extra hard to fight your nails off to ensure that you get the mark. Otherwise, you spend 20 years just claiming, oh, I'm a student of the ACCA. They say, even if you pass some of the modules, but after a certain time, you would have forfeited those modules and you need to start again. So this is a professional course, ladies and gentlemen. Please do not do it alone. You need a tutor by your side. All right. So after you watch the videos, you need to do the assignments, because it is from those assignments that we will then come back to you explaining step by step how you should maneuver those questions. All right. So you will discover that after the first attempt, you might find a 20%. Then on the second attempt, after the tutor has taken you through, you will discover that you can totalize this paper. These papers are very, very easy. You just need a tutor by your side. All right. So in this particular topic, inventory control, we will focus our attention on those mechanisms which enable us to minimize inventory costs. All right, so there are two important costs we will discuss. The first cost is the inventory ordering cost, and the inventory holding cost. But somebody would say those costs are not normally visible. The visible costs in most situations is the purchase cost, the purchase price. But the problem with the purchase price is that managers do not have control over that price unless only there is an incentive for a discount. Without the discount, the purchase price is just like a fixed cost. You do not have control over it. You are going to pay that price no matter what, unless there are chances for quantity or early settlement discount, where the price is now a variable price. So please bear that in mind as we delve deeper into this topic. Now, why do we have to hold inventory? Remember, we say that the inventory holding cost is one of the relevant costs in this situation. But why do we have to hold inventory in the first place? We need to hold inventory to ensure that any unexpected demands can be met, thus to meet what is called erratic demands. Sometimes, from nowhere, customers will just come up and start to hold all your goods, and your shop is left dry. Yes, you have enjoyed quick sales, early sales, but you will discover that you might need, you were not, ready for that, drastic sale. You might have not been ready for the drastic sale. Why? Because when the shop is empty, then it simply means that the employees are going to be paid for nothing. So you then need the idea of inventory control or inventory management, where we say that you do not need to have a day in which you will be having your employees sitting idle without anything to sell. You should have planned ahead. You need to plan ahead. So this is the purpose of this topic. You need to plan ahead to ensure that in any case, you're not going to run out of stock. You're always stocked. The situation that happens in many shops around the countries, especially in developing countries, where in some situations they might end up having having to close shop because they've run dry, they've run out of stock. That's not a good way to do business. Managers should plan ahead. You need to ensure that all the erratic demands that might happen are covered. Okay, so that's the first reason why you need to hold inventory. Then you need to meet any future shortages. Here, we are simply saying that the supply is not always guaranteed. Even if you would have planned to meet demand, sometimes you would discover that it's not an issue of demand, but something that is linked to the general shortage of goods, right? The general shortage of goods. So, for example, one supplier, is supplying you and other competitors. You need to ensure that you have secured considerable quantities from those guys, regardless of the demand. But you just want to safeguard the supply. So you make some mechanisms to ensure that you negotiate ahead of time with the suppliers such that you're not going to run out of stock. Then the last idea or reason why you need to hold stock is to capitalize on bulk purchasing discounts. So if there are quantity discounts available, you need to utilize them. So it is better to order more so that you pay less. Sometimes they say if you purchase 10,000 plus goods in any order, then you are entitled to a 5% discount. So you need then to say, oh guys, why can't we invest in a warehouse so that we capitalize on cheaper purchase price? And by having a cheaper purchase price, then you are also going to win the customers because your prices are going to be cheaper and you will be at a good competitive edge. Are we together, ladies and gentlemen? Okay. Okay, now we now know these things, okay? The first cost involved in ordering inventory, all right? There are three costs whenever we want to make an order, all right? We are going to meet three costs. The first cost is the purchase cost. But this is the price, the actual price of the good from the supplier. It is charged by the supplier. Okay, but the problem with this one, we said that managers do not have control over it. So therefore, it is irrelevant. Then there is what is called the reorder cost, sometimes called ordering cost. As we proceed with the lecture, you discover that we normally use these terms interchangeably. All right, so there are some modalities administrative in nature. Whenever you are placing an order, let's say you want to procure goods from Dubai, there are certain modalities which are going to, cause you to have an outflow of cash. Maybe you would want some lawyers to be involved. Maybe you are going to use a number of agents, okay, procuring agents or brokers to ensure that you have those goods ready. Otherwise, if you do not involve those guys, your goods are not, or they are not going to be delivered. So the delivery costs, the administrative costs, legal or otherwise, they need to be included in placing an order. So those are the monies you're going to pay, but they are not part of the purchase cost. All right? They are just those, modalities, import duties and so forth. All right? So they need to be considered. They are part of the ordering costs. If there is a fixed amount payable on each order, then higher order quantities will result in fewer orders. All right? Needed over a year, and therefore a lower total reorder cost. So if these ordering costs are fixed, if they are fixed, all right, if they are fixed, let's say, for example, whenever you are placing an order, you need to pay $50. So if you order 5 items, it means the cost per unit is $10. That is 50 over 5. It comes to $10. But if you order 20 items, the cost per unit becomes $50 over 20, which means it comes to $2.50. So if the ordering cost is fixed, then to buy more quantities, to buy 20 items is better than to buy 5 items at once. So whenever you are placing an order, it is better to place a very big order, because even if you buy a small order, you're going to pay the same admin fees. So it is encouraged that you buy or you place orders in large quantities. All right? But you also need to consider inventory holding costs. These are the costs of preserving the items or of keeping those items safe. You need to consider if you have got a good warehouse, if you have got good refrigeration facilities. For example, you procure fish from Kariba. We have got in Zimbabwe, we have got what is called the Kariba Dam, a magnificent lake. All right. It's actually a tourist attraction. If you visit Zimbabwe, you just have to visit Kariba, Lake Kariba. There are good carpenters there. Carpenter fish, not carpenters for building, but carpenter. Okay, carpenter. All right, it's a type of fish. All right, there are carpenter fish there, and it's just a good outing, a good tourist destination. So you need to visit that. So if you procure your fish from Kariba, but you do not have good refrigeration facilities, you discover that your holding costs are going to be up. Why? Because either you're going to hire or to rent, or let me just say to lease a refrigeration facility from somebody to ensure that your holding process is going to ensure that the product is not destroyed, the fish do not run decay, or they do not get rotten. So you need to ensure that you have got those facilities. You need to ensure that you have got enough energy When we talk of energy, we are talking of electricity or otherwise, be it solar, anything that will enable, the refrigeration process to be in order. So warehousing costs are going to be a thorn on the flesh if your orders are too big. All right. In as much as you have enjoyed maybe the discount during, in terms of the order size, you are going to face the holding cost. So the purpose of this topic is to, to inform you or to educate you on what's the best order size there. This is where the principle of the economic order quantity comes in. You need to, to utilize or to use or to go for that order quantity that is going to minimize these costs. When combined, you just need to, to choose that order size that is going to minimize a combination of both reorder costs and inventory holding costs. All right, so we have got this particular example of Rwandan. Rwandan has demand for 40,000 desks per annum, and the purchase price of each desk is $25. Their ordering cost of $20 for each order placed. So whenever you make an order, you are going to pay $20. So a buyer has a choice of placing 500 units of order, 750 units order, 1,000 units order, or 1,250 units order. But we are told inventory holding costs amount to 10% per annum of inventory value. So the reason why we are given this, we have said that initially that price is not relevant if there are no discounts. So how come here it has been put there? Yes, it has only been put to confuse you in the examination. But it is also essential to note that the holding costs are 10% of this value. So they are 10% of $25. So the inventory cost per unit is 10% of that value of the $25. So insofar as this question is concerned, that price or that figure, the $25, is relevant for the benefit, for the basis of our computation. Calculate Rwandan's inventory cost per annum for the following order quantities and plot them on a graph. You are not going to be required to draw any graph or to plot any graph in this examination, but we have put this here so that you understand the principles, because it is better for you to understand the theory. Otherwise, if you do not understand what we are talking about, then you are not going to do any favor to your heart. All right, so we need, as tutors, we need to preserve your heart to ensure that you are covered. So let us attack this question. So what is required here is just a table. All right, from the table, we then have to be able to come up with a graph whatsoever. Okay, so let me just draw a graph here. A table, right, that is going to cover all these guys. All these items. Okay, so first of all, we need the order quantity. the order quantity, all right, and the number of orders, and we know that we have got to do the reorder cost, but we are told the cost of ordering is $20 for each order placed. So we come here and say reorder cost. We know that this is $20 per order, all right? And then in another column there, we'll need the average inventory. Then we have got the holding cost. Let me just say stock holding costs per annum. Stock holding cost per annum. All right. The reorder cost can be bracketed 1, and this one can be bracketed 2. All right, because these are the two costs we are interested in. All right, and then we get the total inventory costs. All right, that is, we are talking of 1 plus 2, right? And the 1 is this one, and the 2 is that one. All right, so the figures in those columns should add to one another to get the total. All right, so let's start with the order size of 500 units. All right, we have got the order size of 500 units, but we have the demand of 40,000. The demand is 40,000, all right? So how many orders can we make? We have got the demand, which is going to, affect our, number of orders. All right, so in a year, we are told that we can sell 40,000 desks. So if we place orders of 500 desks per order, it means in a year, we are going to make how many orders? 40,000 divided by 500. The zeros cross out each other, and we've got a 5 into 40, that's 8, and there is a 0 there. So we are looking at 80 orders. But the reorder cost is, or the ordering cost is $20 per order. So 20 multiplied by 80, that's 1,600. Now, if you are ordering at an order size of 500 units, so the average inventory per order made or at any particular time, it would be 500 over 2, and this comes to 250 units. Okay, now if at any given time, on average, we are going to have 250 units in the warehouse, but we are also told that the cost of holding 1 unit of inventory is 10% of the purchase price of that unit. Then it comes to the holding cost of, so we are looking at the holding cost of 250 items, which is the average inventory, multiplied by $25 multiplied by 10%. The 10%, okay, should be 10% of $25, which should be here. You can safely just say $2.50. Okay, so the stock holding cost is $2.50. So instead of rambling about, you just need to say 250 multiplied by, 250 multiplied by $2.50, and you should get $625. So the total cost for this quantity for the 500 units order should be 1,600 plus 625. Why? Because we are only interested in the reorder cost and the holding cost, the stock holding cost. So 1,600 plus 625, this should give us 2,225. So we do the same for 750 units. The number of orders would be the demand 40,000 divided by 750, and we must get about 53.33 orders. And the reorder cost is $20. So $20 multiplied by 53.33, this should give us 1,067. And then the average inventory, here the average inventory is 750 divided by 2, and this should give us 375. And 375 multiplied by $2.50, this should give us 938. Then we add 1,067 plus 938, and we should get 2,005. We go to the next order size, 1,000 units. 1,000 units. Okay, and the number of orders is now 40,000 over 1,000 units, and this time we are looking at 40. All right, the reorder cost. The reorder cost is $20. So $20 multiplied by the order size, by the number of orders. All right, this shall lead us to 800. Okay, 40 multiplied by 20, that's 800, ladies and gentlemen. Now the inventory, the average inventory, that's 1,000 divided by 2. This comes to 500. But I want you guys to appreciate one thing. As the order quantities are increasing, the average inventory is also increasing. All right? Good. Now, the stock holding cost. The stock holding cost. This one, we are saying that per unit, that's $2.50. So 250 multiplied by 500, this shall give us 1,250. If we add 800 and 1,250, we are going to get 2,050. Then we come to the last one, 1,250 units. All right, and the number of orders would be 40,000 divided by 1,250, and this gives us 32 orders. So we're going to place 32 orders only in a year. Okay, and the reorder cost would become 32 multiplied by 20, and this gives us $640. Then the average inventory should be 1,250 divided by 2, and this would give us 625. Please verify with your own calculators that side. Then the stock holding cost. This is the average inventory multiplied by the holding cost per unit of $2.50, and this comes to 1,563. Then we add 640 and 1,563, and we must get 2,203. Now, you need to plot these items on a graph, right? That was the question. So we come here and do the graphic, right? We can say these are the units, okay, ordered, or the order size, and these are the costs. Okay, so we are having our order sizes. The order sizes, we are having 500, 700, 1250. So in drawing a graph, you just have to scale up to have an idea of the scale. So the largest unit is 1250. So if you come to the number line, you can simply say maybe this one is 500. So this one is 1000, and this other one is 1500. Okay, then on the monetary scale, again, you can then ask yourself, what is the least value and what is the largest value. So the least value is 2005, and the largest is 2003. So to save yourself much headache, you can just say, okay, this one is 1000, this one is 2000, and this one is 3000. Simple, isn't it? Then you're drawing graph. Okay, like I said, the idea is just for you to appreciate what is going on. You mustn't be lost along the way. All right. So the first order size was 500 units, and the total cost for 500 units, remember the 500 units, these ones, the total cost is 2225. So if we come to the graph, we can simply guess that somewhere there. So the 2200 is somewhere there. So let us link it. It should intersect with the 500 line. All right. So we are on this. That's where we put our X. Then I'm giving a revision of your ordinary level mathematics, isn't it? Then on the order size of 725 units, the cost was 2005. Okay, so 750 where the units, so 750 should be in the middle here. Okay, but we are told that the cost was somewhere here, almost somewhere here, 2005. 2005, so it's a bit lower there. All right, we're just estimating. Yeah, you're not going to be given any mark. You're not going to be tested on graphing, okay? But just have the idea. All right. From there, we come on to the 1000 order size. That's the cost is 2050. So 1000 is this one, and we are told that the cost is 20. So it's a bit higher than the previous one, than the previous figure, but they're almost close, but a bit higher. Okay, and that height matters. Then last one, the 1250 units. Okay, and this one was a bit higher, a bit more higher. So 2203. This was 1200. So 1250 should be somewhere in the middle, isn't it? Yeah, 1250. So this one should be somewhere here. So, ladies and gentlemen, the question was saying, you just need to determine the inventory cost, okay, and you plot them on the graph. But after plotting, right, you can just come up with a little trend diagram, okay, the trend. All right, so this is the graph of the total cost, total inventory cost. Now, at which point do you feel the costs of inventory are going to be minimized? Obviously, you will appreciate that at this point, the inventory the inventory costs are at their minimum. So this order size is actually favorable. What is this order size? This was the 750. Okay, so at 750 units, the order is going to be very economic. We're going to pay very few dollars to place that order, to place and hold that order. Remember, we have been looking at the combination of both the ordering cost and holding cost. So if we order 750 units at a time, if we make an order of 750 units at a time, whenever we place an order, then our total costs are going to be minimized. Are we together, ladies and gentlemen? Good. Let's move on. Now, we have been doing trial and error, which is synonymous to people who do not have financial acumen or who do not have management costing knowledge. Now that we are learned people, we are now using the EOQ instead of trying to do trial and error. Shall we? Let us work out if the 500 units is going to give us some economy, or let us maybe try to use the 1000 units. We were just jumping across jumping at all places or around all places. We were all over the place, so we were not quite sure. It took us much time to arrive at the economic order quantity we wanted. So now we now have the formula for the EOQ. Let us use this formula to do the computation. Maybe we should use the same example, but let us first understand what this EOQ is all about. All right, the EOQ is the reorder quantity, which minimizes the total cost associated with holding and ordering stock. That is, holding costs and ordering costs. At the EOQ, this cost will be at a minimum. All right, as we have seen in that graph, at the EOQ, the inventory costs will be at their minimum. So there is a formula. EOQ is given by the square root of 2 COD divided by CH. When we talk of D, we are talking of the annual demand. The CO is the cost of placing one order, and CH is the cost of holding one unit for 1 year. There are assumptions which are associated with this formula. Average inventory held is equal to half of the EOQ. Right, so we have been talking of when we calculated the stock holding costs. All right, we were driven by the average inventory, if you still remember, and the average inventory was the order quantity divided by 2. But in this case, we are now using the EOQ divided by 2. So that's the average inventory. All right. So in an examination, sometimes they will ask you to compute something that requires the variable average inventory, and they've given you the EOQ. Obviously, you just have to divide that EOQ by 2 to arrive at the average inventory held. The number of orders in a year is equal to expected demand divided by the order size, the economic order quantity. We have been doing that a few minutes ago. Total number holding, total annual holding cost is equal to average inventory divided by 2 multiplied by the holding cost per unit of inventory. So you can see that all these assumptions are the things we have been doing so far. Total annual ordering cost is equal to the number of orders multiplied by the cost of placing an order. There is also a formula that allows us to calculate the total annual cost. That is the total of holding cost and ordering cost. So TAC is equal to CO multiplied by D over Q plus CHQ over 2. This is what we have been doing so far, right? But it's only that it is now being put mathematically in a formula. You might be dazzled, but you can see because the CO, we are talking of the cost of placing an order multiplied by D, which is the demand, the annual demand, and the Q is the order size. This is the order size, or the EOQ. Then CH is the cost of holding 1 unit of inventory, okay, multiplied by the average inventory, the EOQ. All right, so you can see that the cost of holding 1 unit multiplied by the average over 2, this is actually the holding cost formula. And this other segment, the CO, this CO, sorry, my drawing is very poor. The CO multiplied by D over Q is actually talking of the ordering cost. Are we together, ladies and gentlemen? So that's what we have been doing. Now let us use the formula from the previous example. All right, we have the example. All right, and let me just show you the question once more, and we are simply doing the same thing. All right, so let's compute. Let me try to tidy up the players, because I understand you guys. You can be easily get tangled. You can be easily get tangled. Okay. All right, there's a phone call. Okay. I think we need to proceed, ladies and gentlemen. I'm looking for a brighter pen. Okay, now we are now using the EOQ formula. The EOQ formula, and we say that this is 2CO D over CH. All right, so I want you to appreciate one thing, ladies and gentlemen. All these items are under the bracket, under the square root. So you can first of all solve all these items, but do not forget to then subject them to the square root. All right, so you can put all the information in the brackets. So 2 multiplied by cost of ordering. Cost of ordering or cost of placing an order has been given in the question as $20. Multiplied by the demand, that is 40,000 desks. All divided by the cost of holding stock or inventory holding costs, and these have been 10% of the purchase price of $25. So that's $2.50. This means that if we punch our figures correctly, okay, if we punch our figures correctly, you must get 800 units. All right. Initially, we had found out that the order size of 750 was a bit economic. All right. This was because we were not precise. We were nearer, but we were not as precise as possible. But you can as well appreciate that it's almost nearer to 800 units. Okay, it's almost nearer, but the formula is more realistic. They were just doing trial and error, but now with the EOQ, we are almost assured of where we are going. So this is the EOQ, which we have just computed. Ladies and gentlemen, we're done. Now, we need to then calculate the total inventory costs. All right. So we know that the reorder costs are going to be the D over EOQ. Okay. The D is 40,000. The EOQ is 800. Remember from the TAC formula, which I have already shown you previously. All right. The TAC formula, the total annual cost, was saying that reorder costs are the demand over the EOQ multiplied by the ordering cost of $20. This the ordering cost. All right, and so the $50 has been found from 40,000 divided by 800 units, and we get the 50 there multiplied by the 20. So the ordering costs are $1,000. And then the inventory holding costs, these ones, we need to determine the average inventory multiply by the inventory holding cost per unit. So average inventory, that's 800, which is the EOQ. The 800, remember, is from the EOQ, okay? The EOQ divided by 2, and we then multiply by $2.50 and also get 1,000. So the total inventory costs are now $2,000 per annum. All right, from there, I think we are now done. Okay, so those are the total inventory costs. Now, there is also this question which has been adopted from the Kaplan revision kit, right? It's almost like an exam standard question. A company uses the economic order quantity model to establish reorder quantities. So the company is actually using this model to inform its reorder quantities. The following information relates to the forthcoming period. Order costs have been $25 per annum. Per order, $25 per order. Holding costs are 10% of the purchase price, which is something which we have been dealing with so far. Annual demand, 20,000. Purchase price, $40 per unit. The EOQ is that much. There is no separate inventory. What are the total annual cost of inventory? The total, in this case, because there is confusion, the examiner wants you then to determine the total annual cost of inventory, and because there is confusion in terminology, he then states that the total purchase cost plus total order cost plus total holding cost. So here your life has been made easier. Okay, he knows the applicability of other theories, that the purchase price is not relevant where discounts are not involved. But in this case, he wants you to determine the total annual cost, including the purchase cost. That information is very essential because by the end of the day, we also need to budget. We need to budget with the known purchase price. Okay, so the reason for putting this formula in your computation is to avoid confusion, because other students will end up only calculating the ordering and holding cost and totaling them up and get their answers, which would be then marked incorrect. So it is very essential not to do rote learning, but you need to understand what the examiner is asking you to do. Otherwise, if you just get into the exam room and say, the ACCA tutor said that when you are calculating the inventory cost, you just have to only consider ordering and holding costs, you are going to fail. So you need to, to safeguard your heart. You need to protect yourself from disappointment. Understand what the examiner is saying, is requiring you to do. Whenever you are doing assignments, please make sure that you read the question requirement very, very carefully. So in this case, the purchase cost is equal to the number of units demanded, all right, multiplied by the purchase price. And the purchase price has been given, ladies and gentlemen, the purchase price is there, $40 per unit. And the demand is 20,000 per unit. So this is why you are seeing this information on the screen there. This is the purchase costs, the purchase costs, which are a product of the demand and the purchase price. Okay, demand multiplied by purchase price, and we get 800,000. Then the order cost, we are having the demand divided by the EOQ. Okay, the EOQ, ladies and gentlemen, has been given as 500 units. So multiply by the cost per order. The cost per order, ordering costs are $25 on the screen there. So you get your $1,000. We move on to the holding costs. Holding costs are a product of average inventory. Okay, average inventory, that's the EOQ divided by 2. Okay, the EOQ was 500 units divided by 2 multiplied by the holding cost per unit. Holding cost per unit, and in this case, that's 10% of the purchase price. The purchase price is $40 multiplied by 10%, and this should be $4. That's why you're seeing a $4 there, and you get that. And the total costs are $802,000, and your answer in the exam would be 3 there. Pick choice 3 and move on with your good life. All right, that's another. You can attempt that question. Okay, you can just attempt that question and put your answer on the comment section to this video, and I will just say hi, how are you? That's a good answer if you have obtained the good answer. All right, but just follow the principle. Sometimes the examiner gives you this question and says that he wants you to use the spreadsheet formula. All right, so the square root in the spreadsheet is simply, in the spreadsheet, you just have to say equal sign square root, equal sign square. The square is SQRT. So equal sign square root, and then you put whatever information in the bracket, like A3, right? A3, like, okay, remember we start with the 2CO, so that's 2 multiplied by A3, right? And multiply by the demand. Maybe the demand would be in another cell like C4, etc. But what is important is You just have to then know how to arrange these, right? And sometimes because there is all these, I said all these should be in one bracket. So you would then need to put two brackets there, because when you finish the numerator, you put your close bracket and then you put your slash sign there, and put the cell of the denominator, the CH could be in E2, all right, depending on where the examiner has put those information on the spreadsheet, and then you close your final bracket. So do not be hoodwinked with those things, because they know that this formula, the EOQ, is going to be found. You are going to be given the formula in the examination, but to just add value to the examination, the examiner will just say input the spreadsheet formula applicable. And you just have to tell yourself that, oh, the square root. You just have to first of all put an equal sign. If you choose an option without an equal sign, you're going to fail, because to input a formula in the spreadsheet, you first of all have to put an equal sign. Am I talking to somebody? Thank you. So there was another issue of discounts. Let's talk of a situation when there is a discount. All right, so if there is a discount involved, then the purchase price starts to matter now. So what do we do? First of all, we need to calculate the EOQ, ignoring that discount. All right, that's what we need to do. And then if the EOQ is below the quantity which must be ordered to obtain the discount, then calculate the total annual inventory cost. And then recalculate the total annual inventory cost using the order size required to just obtain the discount, and compare the cost of step 2 and 3 with the saving from the discount and select the minimum cost alternative. Repeat for all discount levels. So that's what you need to do. So we have got this example. All right, we've got example there. Dark face has demand for 40,000 wardrobes per annum, and the purchase price of each wardrobe is $25. There are ordering costs of $20 for each order placed. Inventory holding costs amount to 10% per annum of inventory value. Darkface supplier offers discounts on purchase price as follows. If you order between 0 and 5,000 units, you are not going to get any discount. So if the EOQ is within this range, then we're not going to get any discount. You just have to proceed to compute the total cost, ignoring any discount information. All right. If the order quantity is between 5,000 and 10,000, and less than 10,000, let's say up to 9,999, then we are going to get a 1% discount. If it is over 10,000 plus or to infinite, we are going to get 1.5% discount. Let us now calculate the economic order quantity. Now, in this case, let us first of all compute the EOQ, all right, and that has been done by the tutor for you. The EOQ is already there as 800 units as seen on the screen there. Now the reorder costs, you just do the same processes, that's demand over EOQ multiplied by the cost of placing an order, and we get 1,000, and inventory holding cost 800 over 2, which is equal to and the 800, remember, is the EOQ divided by 2 multiplied by 250, which is the cost of holding 1 unit of inventory, and we get 1,000 there. Right, and this cost, this 250, is just the 10% of the purchase price of $25. So the total inventory costs are $2,000 per annum. Then you move on to the order quantity, which you then move on to the computation of the total annual costs, ignoring the discount. Why? Because we have seen that this EOQ is below the discount level, right? So we just proceed to compute ignoring any discount. Remember, we will use this information for benchmarking. We want to see if it is advantageous to go for any discount. Otherwise, we are safe to just continue with our EOQ environment because there's no extra incentive. Remember, the purchase price is only applicable where it is within the range of discounts. If we are going to get a discount, then that's when we start to make use of this purchase price. Other than that, we are well off to just remain in our EOQ environment. So the purchase cost, all right, the purchase cost is the demand multiplied by the purchase price. Demand multiplied by the purchase price. The demand was 40,000 wardrobes, and the purchase price per wardrobe was $25. So we get $1 million. Then inventory cost, that's $2,000. We computed this one here. Okay, that's the 2,000 we are talking about, and we get a total of $1,002,000. Right now, what about the order quantity of 5,000 units? At 5,000 units, the examiner says we will be entitled to a 1% discount. So therefore, our purchase price is now multiplied by 99%. Why? Because we have deducted a 1% discount from the purchase price. So 40,000 multiplied by 99% multiplied by 25%, $25, we are going to pay $990,000. The reorder quantity, we just do the formula as usual, 40,000 divided by 5,000, because the order size is now 5,000. So it comes to 8 orders in a year, multiplied by $20 to place an order, and we get $160. We come to the inventory holding cost. We are talking of 5,000, which is now the order size. Remember, we are at 5,000 units divided by 2, we get 2,500 multiplied by the 99% of $2.50. Why? Because we are now, remember, the holding cost, according to the question, has been 10% of the purchase price. Now, if the purchase price has been reduced by the discount, therefore the holding cost will also be affected. So this is why we are now multiplying the 250 by 99%, and we get that figure. You total up and you get this amount. Remember, by the end of the day, you need to compare if these costs are going to justify a continued use of the EOQ or to go for the discount. So far at 5,000 units, we have seen that we are going to pay lesser, 996,000 instead of 1,002,000. So obviously at 5,000, we are now being hopeful. We are hopeful to go for larger quantities. Then it is also dependent on the fact that we have got enough warehousing and so forth. Otherwise, by the end of the day, we will be at risk of it. But it has already been catered for. Why? Because when we computed the holding cost, we had all the information required. So the cost of warehousing, everything has been catered for in the inventory holding cost. So here it is just a one-way thing. If the amount for the discount as a whole is going to be cheaper, then we are right away going to go for the discount. Now, at 10,000, at the order size of 10,000 units, we do all the computations and we arrive at 997. So this one is larger than this one. So obviously, the best choice should be the 5,000 units, as you can see on the screen there. We are done. We are done. Now, there is this animal called economic batch quantity. All right, the EBQ model is primarily concerned with determining the number of items that should be produced in a batch compared to size of an order with the EOQ. The formula for the EBQ is as follows. So this formula you're not going to be given in the exam. So you need to memorize this one. But it's very easy, right? Because it's almost like a modified EOQ. The only modification occurs here. All right, the CH has been given another brother by its side, such that you just have to at least adjust your mind. But everything is just the same. The D's are the demand per annum. All right, instead of the Q, the EOQ has been only, instead of the economic order quantity, we now want the batch quantity. So we've substituted the O with the batch, the order with the batch. All right. So the formula is, interested in determining the number of units in each batch. How many units should you produce in every batch? Okay. So the CH is still the same figure. The R now, the R is the annual replenishment, the annual replenishment rate. This is also called the production rate time, time period. All right, so you will understand this with the example. So we have got AB Limited, which makes a component for one of the engines that it builds. Okay, so this company makes some components for the engines which it constructs. All right, so it uses on average 2,000 of these components steadily throughout the year. So they use these components in their production for the engines steadily through, about 2,000 on average throughout the year. All right, so we need to be informed as we will be reading. We need to be informed to have these figures slotted in the formula as you will be doing the reading. Otherwise, if we simply just read and read and read and read, we're not going to go anywhere. So what is the 2,000? The 2,000, ladies and gentlemen, is our demand. Okay, so we have, let me use a different pen. We are getting the information for the demand. So this is our D. The component costs $16 per unit to make, and it costs an additional $320 to set up the production process each time a batch of components is made. So what is 320? Okay, now the 320, ladies and gentlemen, this one is our CO. It's like the cost of placing an order, right? Because here we are talking of the cost of a setup, or whenever we want to do some manufacturing, we need to ensure that all the machines are well set and everything. Maybe we'll need to hire somebody to do those setups to ensure that there is good alignment and everything. All the machines are ready for the production. So we need some engineer of some sort to be hired to ensure that everything is in place. So that's the cost of placing an order. All right, so that's our CO. All right, so what about the $16? This is just like the purchase price. So it's not relevant, right? It's not relevant, but it is relevant when it comes to the computation of the CH, because we are told that the holding cost per unit is 10% of the unit production cost. So this $16 is the cost of making the item, which can be which can be related to the purchase price in the EOQ environment. So in this case, our CH, the CH is going to be 10% of $16, which comes to $60. The $60. Okay, the company makes these components at a rate of 200 units per week, and the factory is open for 50 weeks per annum. So the rate, remember, this is the rate of production, okay? Production rate, and remember, we are talking of the economic batch quantity. So this is our R, production rate, and we are told that they make 200 units per week multiplied by 50 weeks in a year, which means they make 10,000 units. So that's our R. The formula is done. So what you then need to do is to slot in the figures in the formula to ensure that you come up with your EBQ. All right, the EBQ, that's the square root of 2 multiplied by CO, and the CO, we are told that this is the 320. All right, that's the 320, ladies and gentlemen. 320 multiplied by the D. The D is the 2000. I've already shown you this D, which is the 2000. And then you have to divide by the CH, and the CH is $60. $60, all right, multiply by this troublesome kid. 1 minus D is 2000 over R. R is 10,000. And then you need to ensure that you punch these figures correctly, and you must get how much here. Let me punch these figures. You must get 1,000 units. If you don't get 1,000 units, then your answer is wrong. Or just have to place a comment in the comment section to this video so that the tutor knows where he was wrong. Okay, and this is another example, ladies and gentlemen, which you can as well use from whatever angle you are. Remember, the tutor loves his students so much, so he doesn't want to starve them. So you can as well make use of this example as it has been worked for you. All right. Do I still have anything to comment about? Okay, now there is a situation when you need to know when to actually make a reorder. You also need to understand the concept of safety inventories. So, reorder level. This is when inventory held reaches the reorder. When inventory held reaches the reorder level, then a replenishment order should be placed. Okay, so in order to ensure that we come back to our original inventory levels would then be required. So at that level, that's what we call a reorder level, the level at which we now need new orders to be placed, right? Then lead time. This is the time expected to elapse between placing an order and receiving an order for inventory. So whenever you place an order, it is usually not possible to receive the orders right away, unless in a just-in-time environment. But in reality, sometimes you need to spend some weeks before the order comes. So you need to consider that period, the period between placing an order and receiving the items. Then reorder quantity. When we have reached the reorder level, we need to determine what would be the order size. What should be the order size? So the reorder quantity is like the reorder size, or the order size during which we are doing the replenishment of the inventory. All right, and if we have got the EOQ, we just have to use the EOQ. All right, so in the exam, the reorder quantity can be inferred as the EOQ. Demand, this is the rate at which inventory is being used up. It is also known as inventory usage. If the demand in the lead time is constant, the reorder level is calculated as follows. Reorder level when demand in lead time is constant is equal to usage multiplied by lead time. Important formula to note. Reorder level is equal to maximum usage multiplied by maximum lead time. Maximum level is equal to reorder level minus average usage multiplied by average lead time. And we have been told that usage sometimes is equal to demand. Excuse me. Maximum level is equal to reorder level plus reorder quantity minus minimum usage multiplied by minimum lead time. Average inventory is equal to buffer inventory plus reorder quantity. And we know that reorder quantity is the EOQ. So you need to know these terminologies so that you are not going to be lost in the exam arena. All right, so there is this example, ladies and gentlemen. A nationwide electronics retailer stocks a popular laptop model with the following details. Daily demand, 175 laptops. Lead time, 16 days. And we have already seen the word demand is also usage. All right? Sometimes they use demand, sometimes they use usage. So you just have to understand at which are we talking about. All right. So we are told a nationwide electronics retailer stocks a popular laptop model with the following details. Obviously, it's appropriate to use demand than usage. You understand? Do you get it? Good. But if they were a manufacturer and they need that particular item or material, they tend to use daily usage in the factory. Is this and that. So you then need to understand the scenario. So in this case, this is a retailer shop, right? And it's all about the demand, right? The demand, what customers need to buy. So we then need to plan our inventory in terms of the demand expected in a day. So every day there is a demand of 175 laptops. The lead time, if we place an order for those laptops from suppliers, we need 16 days. Reorder quantity, that's 3,000 laptops. Whenever we are making an order, we need to ensure that they reach 3,000 in quantity. That's the order size. Based on this information, at what inventory level should a new order be placed to avoid stock outs? So using the formulas we have been talking about, reorder level is equal to maximum usage multiplied by maximum lead time. So what is the maximum usage, or the usage rather, right? So we come here, say reorder level is equal to usage multiplied by lead time. So usage, we say that it is the demand. You tell us what demand, that's the usage. So that's 175 laptops multiplied by the lead time. This gives us the reorder level. So such that whenever our laptops in the warehouse reach this, or in the shop floor, if they reach these quantities, we need to place an order. So 175 multiplied by 16, this gives us how much here? This calculator of mine, 2,800 units. So the answer is B. A company has demand. This is another example, ladies and gentlemen. Here we now have surfeit inventory, okay, or buffer inventory. All right. Sometimes, even if we know the reorder level, we just need to be extra safe. So we ended up having some buffer. All right. So a company has demand for 100, from customers of 100 units per week. The time between placing an order and receiving the goods, the lead time, is 5 weeks. The company has a policy of holding safety inventory of 100 units. What should be the reorder level? Okay, so in this case, we have got a policy of safety inventory or buffer inventories. So we need to first of all calculate the reorder level without the buffer in place. So we know that reorder level is equal to maximum demand or maximum usage multiplied by lead time. So this gives us the initial, let me just say initial reorder level. So usage is 100 multiplied by the, that's 100 per week, multiplied by how many weeks of lead time? 5 weeks. So we are talking of 500 units. All right, 500 units. That's the, if our stock reaches 500 units, we get the reorder level. We will be at the reorder level. We need to place orders. That's when we need to place orders. But now we are extra careful. We have got to ensure that we have got 100 extra units in place as surfeit inventory. Things might happen which we do not expect. So we then have to add the buffer inventory of 100 units, and we now get get the adjusted reorder level. This is the reorder level we need. So we are talking of 600 units. Are we together, ladies and gentlemen? So this is the presentation, ladies and gentlemen, which I wanted you guys to enjoy today. All right. So until we meet again, ladies and gentlemen, until next time, please be safe. Love yourself. Love your life. Love your ACCA studies. Thank you. I'm signing out. Goodbye.